Good morning, ladies and gentlemen. This is Clueless 8. This is a pre-market AM report on Friday, March 18th, 2016. We have had a very powerful breakout in the markets, and as forecasted many weeks ago, in fact, pretty much off the lows, give or take a day or two, I had shown a strong probability that the markets would follow a similar trajectory based on pattern symmetry of what had happened as recently as August of 2015, the flash crash, the retest on September 29th, and a similar January crash first part of this year, um, which culminated in the hammer reversal on the 20th of January, and then this one, which culminated on the 11th of February. Bottom line is, if you just take a quick snapshot and blink your eye, you're going to see that these pattern symmetries are almost exact. So if that is the case, I'm just giving you a very simplistic view, and I've talked about this extensively and in far more detail in my advanced coaching sessions and some of my previous videocasts. So today I'm just going to skim through. But if you look at this, the pattern symmetry, you can clearly see what's going on. So at this point in time, we are on top of the rising wedge. So we have to start getting a little bit cautious, because once you get towards the 2050 level, this is obviously the E-minis, but once you get towards the 2050, 2060, 2070 level on the S&P 500, which is pretty much around the corner, we're at 2041, I believe, at the close yesterday, 2040.59 to be exact. But once you get towards these levels here on the upper Bollinger, on the E-minis, which are 2046, translates into about 2053 on the S&P 500, you got to use discipline, because there will be a quick, sharp correction. As I like to point out, the internals will need to get reset, and it's just going to happen, period. If you want to look at the pure pattern symmetry of where we might end up at the end of March, which, by the way, is 8 business days away, because we have a holiday for Good Friday on the 25th. So we have 8 days to end the first quarter of 2016. And I've said this clearly, that the large 800-pound gorilla in the room, that's the institutional mutual fund complex, and the managed money complex, wants to make sure that they print a decent return for the first quarter of 2016. Client retention is the name of the game. So there's going to be significant window dressing, where they're going to fluff up their portfolios with better performing stocks, in many cases high beta stocks, high momentum stocks, which provide alpha or excess return on their portfolios. Keep in mind that the market is barely up for the year on the Dow, and still down, I believe, for the S&P 500. So all this drama and all this stuff that we went through, and the pattern symmetries that I kept on showing repeatedly in many other technical indicators that I kept on showing, and behavioral sentiment, still remains to be very much on the bearish side, believe it or not. And I showed that clearly yesterday too. Took a snapshot of the stock to its S&P stream, which has some terrific people in there, and 57+% are still bearish. So you tell me. I don't need to tell you. Look at yourself. Nobody is playing offense. I'm even not playing full offense. And I've been right on this 110%. Still doing very well, but I'm not playing offensive. I'm not going uber aggressive saying, that's it, I'm going to hold a huge, large positions, use more than 60% of my trading capital, which I never do, by the way. Even in the best of times, I have not used more than 60 or 70% of trading capital. Always have to have cash on the side, but I'm not holding very large positions overnight. So if I'm not playing aggressive offense, I'm doing that intraday, mind you, time to time, then what the heck's going on out there? They're all playing defense, and they're missing out a significant portion of this rally. And God bless them, because that's the reason markets climb a wall of worry. If everybody was giddy, then the markets would be overbought. There wouldn't be cash on the sidelines, and we would have topped. We would have topped right here. We have just gone here and gone down. But nope, that didn't happen. Now, let me also clarify one other behavioral aspect that I've talked about recently. People say, oh, there's going to be panic buying. Ladies and gentlemen, ask yourself, have you ever panic bought? I don't think so. Regardless of how lucrative something looks up here because you missed it down here, you honestly think that you are panic buying up here? I don't think so. You're sitting back and saying, I'll wait for it, I'll wait for it. And when the big correction comes, you don't get in. I'm not talking about us, because I think many of you have started to recalibrate your brain. And one of the mottos of 2016 is to start thinking like a robot. Keep your emotions aside. And I think it's working with some of you. Many of you, it's not working yet because you haven't taken the time and energy to really unlock that hidden strength in you, which says, I can do it. I can do this. It takes time, but it also takes effort. It takes interactive engagement, like I do with these advanced coaching sessions, which have been hugely helpful to many people. And I think I've made a difference in their lives in a small way. Anyway, going into that, this whole garbage about panic buying, nobody panic buys. What happens is institutional funds, hedge funds and such, who were basically net short, maybe they were not net short here. They probably went net short around there because at this time the market looked like it was going to edge higher. Okay. So, and then they covered here, and then they probably went net short again here. Let's say, right around this level, thinking, okay, the market cannot break down. We had these consolidation days. They probably went net short here. And now you know, so now they're starting, and then they covered hard. That's the reason why you see these massive, that's the reason why you see, these are big short covering candles continued with bull flags. See that? And it starts here, always starts here. Every major retracement rally or any rally starts with a short cover. That's just the way it goes. And people still behave the same way. It's just incredible. But the reason why people do that is because these volatility algos that are prevalent in the market that cause these type of very sharp moves, consolidative moves, which look fine in hindsight, but don't feel too great when you're going through it, right? So bottom line is, that's where I come in and show, okay, this is the time things are getting a little frothy. I show it in technical indicators, time to ease back, tactical shorts and stuff like that. So as short funds start to get squeezed, you get these big moves up. So at this point, I believe that the ultimate destination is 2075 on the minis, which is roughly 2080 or so in the S&P 500. Okay, and that completes this pattern for now. Once you get there, I believe we come down like we did here. Okay, and that would be coming down and retesting 2000. So that's a 80-point drop on the E-minis. That's roughly a 500-point drop in the market, which I think happens by mid-April. Once you get that, the market will try to attempt to retest that 2080 level and then get towards 2100. What happens around 2100, I have no idea, but my feeling is we are going to get hit because we're going to be getting close to this political turbulence, domestic political turbulence. We're coming into the second quarter, like that old saying, sell in May and go away. There's always going to be selective opportunities in the market. I mean, we're going to be still making money. There's no question about it. Okay, because we're tactical bears. So we'll go short, S&P, RUT. We'll be playing selective plays, and we'll be doing our thing. I'm just giving you a broader picture on the market. Now, the chances of testing another 1800 at this point has been, over the short term, has been removed because a body in motion stays in motion. And the further you move away from it, it's, unless there's a real calamitous situation, okay, another major drop in oil, let's say oil goes back to the 20s, you will get this 1800 move, and it's going to happen fast. But barring that type of scenario, And barring any type of major political upheaval in a significant economy like Germany or China, those are the two primary ones we're concerned with, then this pattern will play through. Let's take a look at a couple of let's take a look at the S&P on a shorter term basis, which would be the hourly. Now I'm going to bring that chart up in a second. Another thing I want to remind people, very importantly, that we are always thinking about what can go wrong. I'm not making this up. It's a fact. A lot of you are in denial that you don't think that, but you are. Everybody, like I said, everyone plays defense. So the bottom line is that what if certain things go right? Number one, what if some of this massive QE and many other policy implementations in Europe actually take hold in a small way in the periphery of Europe, which is Italy, Spain, and all these places, and then in the major central part of it, Germany, the UK, and stuff, and start to show some encouraging signs. That's the one what if. The second what if is, what if China starts to show some improving numbers? What if oil prices stay steady between 40 and 50, which takes away some of the fears of a major calamitous crash of the high yield junk bond market, and banks start to sigh of relief. And as remember, the two things that happened which caused a major drop in the S&P earnings, right? Two things. One is the drop in oil. It raised profits of major oil companies. The S&P 500 earnings dropped because all of them reported losses or sharp decreases in net income, and of course in the EPS. Some of them cut dividends, right? So that took away a bunch of, the earnings revisions went negative. So what if earnings start to stabilize and go higher? Because remember, it's an expectations game, not an absolute game, right? So as earnings start to go higher for oil companies and energy companies specifically, because oil stabilizes, what happens then? And the market has a reason to go higher. Now, markets always overshoot, and at this point, I believe it's starting to overshoot. But I'm talking going out 6 months. And so that's that. There are things to think about. Not just thinking about, okay, everything's wrong with the world, we're all dying, and this type of uber bearish mentality, I don't think has served anyone. There's an old saying I'd like to say, that the history of mankind has been a bullish event. Has been a bull market. The history of mankind hasn't been a bear market. It's a fact. So anyway, saying all that, here's a quick peek at the S&P. You can see here we popped up right there, right? The other thing that I explained the other day is this was literally a 90-degree crash. I like the fact that this is actually moving 45 degrees like this, which is good. And now we're popping. So popping means that over the next couple of weeks, as we get, and the weekly charts in many of my other side are showing that we still have a little bit more room to run. And again, intraday consolidations, multi-day consolidation, these type of red days certainly will come. There's no question about it. But anyway, so given that, the pattern symmetry gets resolved, I should say, at around 2080 to 2100. If we break really hard below 1974, all bets are off. We're coming down hard to test the rising 50 and 34, which is the 1930 level. Anything below 1918, start singing the 1800 song. Okay, we're going down here. Anything below this pattern will get repeated. Just the way it works. All right, just the way it works. But at this point, this is where we are, and nothing more to say. Let's take a quick look at, and I show these charts all the time, so I'm just simply being interactive now, explaining all this. Oh, one of my things here is the Russell 2000, which has lagged because of oil, commodities, and all kinds of stuff. And the Russell is starting to pick up steam. So when I look at the Russell 2000, and I've showed some brilliant charts on this, posted on the real-time Twitter feed, you're going to see, and I think there's a good amount of money to be made, that the retest of the downtrend line, this is a pretty clean looking chart, and I'll tell you how you can construct it. Keep it simple, stupid, right? The KISS principle. Or keep it clueless. How about that? So here what we have is I can draw it like this. Oh boy, hold on. That was the breakout level right there at 1040. You can start to see look at this, the 34. I'm gonna show you all this in a second. Look at the magic at work. It's real simple. Real simple. Just have to know the basis why you're drawing these lines. This is very positive. Still got room to go, even though we're getting into overbought territory. There's a thrust going on here as money comes in. Shorts get squeezed. And these are the things you read into this chart. Real simple. Downtrend line. Easy to identify, right? Downtrend line intersects around 1140. That's 50 points higher from here. 50 points. That's a lot. Pattern symmetry. If you want to look at pure pattern symmetry, you got a big dragon bullish. You're creating a nice little consolidation. It can also be looked on as a cup and a handle. And now we have broken out over the handle. First stop is around that 1140 level because that was the last major supply zone, major selling, and the breakdown happened back at the end of December when Santa disappeared and the beginning of January. And the whole pattern gets completed at 1200. Okay, so 100-point increments. That's basically it. We are breaking 1100. We're going to overshoot a bit, and you can tactically play this, or you can take some long swings out there towards April and say, okay, this thing's going to go to 1200 or 1140. You know, 1140 I think is very doable. 1200, you know, it probably gets there. But this pattern will get, and you know how many times I've been correct. How we manage our trades and we do the trade management stuff and how we don't freak out, that's your business. And I try to do it as best as I can and try to help you all. I'm not perfect at managing trades either. I'll be honest with you. Because when things get really haywire and I got a large position, I sell out too at times for smaller profits than what I should have gotten. But I tend to do it a lot better than other people. So this is the Russell 2000 should be taken into account, you know. US economy shows some stronger numbers. That's a big factor. Banks start to pick up. That's another thing that's doing well. So this is positive. Okay, just wanted to pass it on to you all. And the last thing that I'm going to show you is I put out the Goldman Sachs chart and all that. So let's take a look at the QQQ. And looking at that, a similar story is brewing here. I like this hollow candle. You can see that. That's pretty powerful. I like hollow candles. So at this point, everything is pointing up. So we've got a little bit of room to move. We got some gaps to fill here. So you can look at that. I just got about 2 minutes on this thing. We got a big gap to fill here at 112. I think Apple and some of these guys, as they move higher, can push it up. We got small gaps to fill here. And we are right here at this point. This again, left shoulder, right shoulder, inverted head and shoulders, right? Shown that head. You can also call this a, and then this channel that we're going through. If you draw this out, we get towards 110 or so. And that fills the gap, believe it or not. Everything's very mathematical if you look at it that way. The noise and stuff that surrounds us and constantly barrages us and makes us do stupid things is simply a way to create volatility. What does volatility create? Big money for trading houses. Remember, they say volatility is good. For what? Crazy volatility by algo HFT, algorithmic high frequency trading programs run by hedge funds and stuff. You think that's really great? I don't think so. But they do it because it makes money. Every time you're buying and selling, you're paying a fee. So more volatility, more money. It's a money game. That's why it's capitalism. And don't try to sit here and say, "Oh, I'm going to change it." I know you hear a lot of these candidates say, "I'm going to change the system." Nobody changes the system. The system does what it does. Okay? And overall, the U.S. is still the best house in a bad neighborhood. Our system still works.